So in this video, I would like to build upon our foundational knowledge of fundamental analysis. So if you guys haven't watched the previous video on what fundamental analysis is, please do check it out, because this video will be covering the contents on how we use fundamental analysis, what are the actual metrics that investors use when we take into account and look at fundamental analysis. Now, as we mentioned earlier in the previous video, fundamental analysis is the method and way that investors use, different metrics such as ratios, such as reading companies' accounting, balance and financial statements to figure out the intrinsic value of a stock, to figure out whether the stock is in demand, whether the company is growing, whether the company is earning enough money, do they have strong profits, do they have strong assets, do they have strong partnerships, strong policies, good management, etc. Now, some of the few things that we take a look at when we talk about fundamental analysis. So these four concepts, just the basic. If you take a look at the link I listed down here, and I'll also be link it down in the bottom of this video description. This link here is a website that lists out many different accounting and financial ratios that investors use to value a stock, or investors use to carry out their fundamental analysis to pick a stock. So they take these ratios, understand the meaning of the ratios, to then determine if the stock is viable or not. So most of the time, the ratios, the numerical value of the ratio represents something. It could be a good meaning, could be a bad meaning, it could be one end of the spectrum and the other end of the spectrum. But it's really important to understand that comparing ratios to the industry average, so that average of the industry in which the company is in, or the market average, is really important, because comparison is key. If you compare a stock in, let's say, the tech sector, and he has a lower ratio compared to the average in the market, then we can sort of make a judgment to say that this stock is more valuable than other companies. So when we craft our investment analysis, it's really important to understand the meaning of the ratios, what the values mean, and also the industry average, so you can compare with the market or industry average to get a sense of what's high and what is low for the industry. So now here are some of the ratios and the formulas that some investors use. I put here the basic three along with basic performance. Again, you can check it out more in the link below. It will give a clear explanation. This is just an introductory video. More will be explained. It can be explained if any of you are interested in learning a bit more on different types of ratios, more types of ratios, etc. Now let's first take a look at basic performance. Now, when we take a look at the company, we check many stuff like the cost it has, the assets it has, the liabilities they have, its revenue growth, its profit growth. Are they making money? Are they losing money? So a growing company could be a positive sign. The company is expanding and enough funds to grow larger, enough funds to grow larger, enough money to expand, and that could be a good sign. That could be a sign that the company is doing well, as healthy financial statements. Now, one way investors check this is through checking the company's financial statements, so cash flow statements or the balance sheet. Now, these are the accounting statements that a public company, will release to the public, release to investors, so that investors get a sense on where the company is spending their money, where their profit, where they're spending, etc. So all these can be just found online, usually listed in a company website, or even usually on a company website, so that maybe when you guys are deciding on whether you want to buy the stock, you guys can just search up the company in real life to check out some of their financial statements. And it's important that you guys understand how to read the financial statements. And some of these concepts may be a bit difficult, especially for beginner stage, so I just putting this out here, and no in-depth knowledge should be covered here today. Now, for the price to earnings ratio, so this ratio is the price of each share in comparison to the company's earnings per share. So let's say a company earned 100 million ringgit this year, and they have a total of 10 million shares. You would take the total earning, divide by the number of shares to get the earnings per share. So you're essentially dividing the company's total earning in terms of the number of shares it has. Then you take this value, so the earnings per share, and you compare it to the price. So you can see here the formula of calculating the price to earning, or the PE ratio. If a high PE ratio, that could mean the share price is relatively high compared to the amount of company earning when they divide by the number of shares, which could mean that maybe the company's stock share price is overvalued. It's expensive because the amount of earnings that a company actually makes compared to the number of shares it has is actually lower. So the share low in terms of compared to the share price. So it could be a sense that the stock is expensive or not a true reflection of the actual earnings that the company make in total in a year for the number of shares that the company has. Now, what is the dividend yield? Now, a dividend yield, as we learned in previous video, the dividend is the profit payout that a company pays to its investors. For example, owning one share, you could be entitled to maybe 5 cents a year as dividend. So you take this value of the dividend and you divide it by the share, the price of the share, and you get the dividend yield. So this analysis tells you how much cash or return payout am I getting for the price I pay. So if you have higher dividend yield, that means that the company is paying a greater amount of the dividends compared to the share price, which could be a sign that, oh, it could be a larger income source for an investor. Now, the current ratio measures the company's current assets, so the short-term assets, to its current liabilities, the short-term debt. So why is this ratio important? Because it compares the company's assets to its debt. So in the worst case scenario, where the company has to repay all of its debt, what is the ability of the company to change the short-term assets for money to then repay its debt? So if a ratio of 1, that could mean that the value of the assets are very close to the value of the liabilities. Meaning that if in the worst case scenario, the company will not go bankrupt as it has enough assets to cover its short-term debts. So yeah, these are some of the ratios that are really important. Current ratio, if it's too low, it could be a risk of cash problems. Maybe the current assets are low compared to the debt that the company has, which could increase the risk of, again, cash problems or bankruptcy if the company cannot cover its short-term debts in the worst case scenario, if it has to convert all its assets into cash to repay liabilities. Now, it's really important, again, to understand the meaning of each ratio and to compare it to the industry average. Again, do check out the link if you guys are more interested in learning about more types of ratios. Thank you.